And it is, of course, the first Friday of the month, and that means non-farm payroll day. US jobs and some very interesting numbers have come out over the last couple of hours or so, Nick. Hiring in the United States has surged unexpectedly, which continues to defy predictions of a slowdown, and at the same time raises fresh questions about when interest rates are going to fall. The numbers, very briefly, 272,000 extra jobs in May. And we were talking about this a week or so ago, Nick. We expected a figure more or less 100,000 less than that. So this has come as a surprise to markets, has it not? And a bit of a blow for those seeking rate cuts in the short rather than the medium term.
That's exactly right, because, when you look at this number, there's several things that you could pick out here. You've got the employment change number that you mentioned, the 272,000 jobs that were created, which much higher than the forecast at 180,000. Many analysts kind of thought that we were going to be back down below the 200,000s for a while now, and that would contribute to the inflation progress story. But the other thing that's in this, Johnny, that throws a wrench into the situation is that hourly earnings were strong. They came out month over month 0.4% compared to the forecast at 0.3%. And I believe year over year, they're at 4.1%. And that is a persistent force that is combating the progress on inflation. If you think about it, if everybody is getting wage increases, they're going to go out and spend and travel and purchase things. And that's going to be a stubborn thorn in the side to the inflation story. So this jobs number here today is not something that the market loved, but it's also not something that the market, I'm talking specifically about the stock market for a moment, it didn't particularly hate it either, Johnny. And the reason for that is because of the third variable here. The unemployment rate did tick up to 4.6 from the forecast at 3.9. So we did get a slight uptick in unemployment rate overall. And so there's something to grab at here for both sides, I suppose. That's why if you take a look at least the time of recording this video, the stock market, the S&P 500 specifically, is about flat on the day. That's after hitting all-time record highs in the last several days. So it's kind of an interesting report. The jobs data number here today, it particularly hit hard for interest rates. What we see here is that on the two-year yield is up 2.77%. The latest print there is 4.857. And that, again, combats the story of rate cuts. So when you see a big jump, here's the 10-year up 3% on the day. The idea or the story that's being told there by the bond market is that interest rates are still expected to get cut. I checked this morning when I looked at the FedWatch tool. The forecast right now is solidly around November with a 50-50 shot approximately in September. And that's a different story than what we've seen recently, Johnny, because of course the numbers out of the United States in the last, few days, last week really, we've seen JOLTS jobs numbers or job openings coming down significantly over the last few weeks and months. At the same time, you had PMI numbers that were a little bit disappointing on the manufacturing side, a little better than expected on services. But today's figure definitely takes the cake in terms of importance because, as you mentioned earlier, this is ahead of the next big moving the needle kind of event, which is the CPI print. And a hot jobs print, people getting hired, wage growth, that is, again, a red flag to the inflation story. And we see the dollar index trading up from that 104 level of resistance. If you're looking at the DXY, we bounced off resistance, a very strong green candle here today, and seems to be, at least for the time being, putting in a low on the dollar index. Now we can see that also materializing against other currencies. If you take a look at the euro against the US dollar, it's trading lower right now. If you take a look at the pound, it's also trading lower on the day. This dollar strength is pretty widespread across the board as the jobs print, again, did surprise to the upside in terms of jobs. And the overall story here is that stubborn jobs is not what the market wants to see in order to get rate cuts. Stubborn jobs doesn't necessarily mean, oh, now we're going to hike rates, but it does point to the idea that, well, maybe we can hold off on rate cuts longer, which especially sensitive areas of the market, and a quick example would be real estate. Real estate doesn't love that, right? Because that would mean, okay, for a suspended period of time further, we may not see borrowing costs come down for new home buyers, to offset pressures of people who are, sensitive to interest rates, financial companies. I mean, there are many things that could take a tumble if rates don't see a decline in the coming months. And so again, still up for grabs. It's an election year, so there are many things on the horizon to see what happens next with interest rates. If you enjoyed this video from the Market Insights Market Pulse podcast, you can listen to the full episode by clicking the link down below in the description. You can find us on your favorite podcasting apps, and again, we post several times a week, so if you're looking for market updates throughout the week, this is the place to be. Whether you're in the car on the way to work or something like that, make sure to tune in to get the latest. Thank you very much for watching. We'll see you on the next one.